Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day and spending some time with us. I guess I should start off the first show of the year by saying Happy New Year to all of our viewers. I hope all of you had a fantastic holiday season, got to spend some time with family, and had an enjoyable holiday. And hopefully 2026 will be prosperous and healthy for all of you. We are so excited to start off a new year here at the Allan Small Financial Show. All of us are excited to bring you all the answers, all the information that really, I guess, investors are craving for, that ask me about on a regular basis. All the questions people have regarding the markets, the economy, interest rates, you name it. We talk about everything here at the Allan Small Financial Show. And as always, we promise to continue to bring you informative topics, information-packed shows, the best of guests. We're hopeful to bring on some new guests this year and hopefully bring back some good quality guests from years past as well. So very excited to start 2026, and hopefully all of you can continue to watch throughout the course of the year. Let's put up our topics for this show. There you have them. We're going to look at a snapshot of the markets. The markets, how did they perform this past year? All the numbers are in, of course, now that we are well into January. We'll take a look back and analyze some of the data. Top 3 things to consider before individual investors should make their individual investment decisions. Very popular part of the show. 3 ideas. And a couple of the ideas today are a little bit different. We've talked about them in years past, and we're going to talk about them again on this show. Looking ahead, looking at the markets for 2026, what are analysts, investors predicting? What do they think is going to happen this upcoming year? How will the markets perform? AI. Obviously, we talk about AI all the time on this show. People have questions about artificial intelligence on a regular basis. But lately, we are starting to see AI having unintended consequences. What are those? Well, let's talk about those during that segment number 4. Unintended consequences from AI and the growth of AI all around the world, especially in the United States. This year's limits for RSPs and TFSAs, as we turn the page to a new year, you're starting to hear about people talking about making that RSP contribution in the first 60 days of the new year so they could tax deduct that contribution for 2025 income tax, which everybody will pay by April 30th of this year. We also get an extra amount of money that we can put into our tax-free savings accounts, our TFSAs. That is another $7,000. So we're going to talk a bit about some of those limits. Quick hits. 3 things that we've seen in the news most recently that I wanted to make some comments on. Some of them you're going to know quite well and seem to be the focus of most of the media today. So we're going to touch on those. And last but definitely not least, your questions. As always, I would like to take as many questions as I can. Usually we get to 1 question from the audience that I've received over the past couple of weeks or during the show. And I will want to answer that question on our air today. And if I don't get to your question today, then I will hopefully answer your question on our next show or over the next couple of weeks. So without further ado, let's move forward with our show. The markets, how did they do this year? Well, I guess the short answer is they did extremely well. It was one of the first years that I can remember that the actual Toronto stock market, or TSX, outperformed the New York markets, the US markets, whether it was the NASDAQ, the Dow, or the S&P 500. And let's put up our first chart so viewers can see what I'm referring to. And you can see how well the North American markets performed. There you have them. Dow Jones came in around 13% gains for the year. S&P 500 just over 16% gain. The NASDAQ over 20% gain. Another 20 plus year of growth. This is the 3rd year in a row Third year in a row for all these major indices to do well. And there you have it, the Toronto Stock Exchange up over 31%. We talk about this all the time. Why has the TSX outperformed this past year? And you don't have to look much farther than the sector or topic of gold or materials or silver as well. Silver more than doubled the price this past year. Gold was up well over 70%. You compare that to other areas or asset classes, they did not do as well. Even the tech stocks didn't behave as well as the materials sector. And that's why you saw the TSX, which is made up of 15 to 20% material stocks, of which most of that are gold stocks. That is the main reason for the outperformance. You also had a really good year from Canadian bank stocks. Most of the Canadian banks ended the year, I should say large cap banks, so your big 5, 6 if you add national banks, so your CIBC, Bank of Montreal, Scotia, TD, and Royal, and then National Bank. They had phenomenal years. They ended the year off at all-time highs with respect to pricing, and that in the first couple of days of this year has not slowed down. The banks have had a great run, even in the first few trading days, both in Canada and the US. Our next chart we can show will give us a bit of a glimpse as to how the global indices, global markets fared as compared to the Americas. And even though Toronto Stock Exchange did well, if you look at Americas versus the world versus Asia Pacific Rim versus Europe, you can see that the Americas underperformed many of the other areas around the world. According to this chart, the best performer was Europe, up over 32%. So even better than the Toronto Stock Exchange. And we know that, or looking back now, we know that the European markets really outperformed early on. As we said probably on the show a few times, President Trump with his tariffs tried to make America greater again. And in reality, his tariff policy actually made Europe great again, and they outperformed by quite a bit. And it took the Americas the last, let's say, a couple of quarters, or maybe since the summer, between summer and maybe November. So 6 months between June and November, or 5 months, I should say, to play catch up to the rest of the world. So you can see how well the markets around the world had done. Our next chart is one that we've seen many times. Let's put it up. It is the U.S. stock market powered through a roller coaster year. And it's interesting, if I show you a chart of tech stocks or the NASDAQ or many other individual stocks charts, it would look very similar. A very significant downward, downward spiral or blip down in April, followed by a dramatic increase to the end of the year. And that's when, obviously back last April, is when the tariffs were announced by President Trump, and the markets took it really hard back then. But as you can see, it climbed this wall of worry. So there you have it, Trump tariffs in and around April, tariff pause, bombing of Iran. That is when the United States and Israel started their, campaign bombing of Iran. And we also saw, in October, cryptocurrency, Bitcoin went from about 120, 125,000 US dollars per Bitcoin down to as low as $80,000, lost about a third of its value. Well, the market seemed to shrug that off as well. So a very, very good year, even though we had some crisis and that hit throughout the year. Now, what do we think going forward? Well, the markets, as we said earlier on, the S&P up just over 16%. If I had to put on my crystal ball hat or look forward, I think many investors are thinking that returns will be positive, but not as good as some of the returns that we saw in individual stocks as well as the markets this past year. So more normalized returns. What is normal? Well, since they've been keeping track since World War II, about 80 years ago, more normalized returns are for the U.S. S&P 500, somewhere around 10%, plus or minus a little bit. The Toronto stock market is probably 7-8%. That's the expectation. That has been the average since they've been keeping track. And as you can see over the last few years, especially last year as well, that the indices made a whole lot more. Let's go to our next chart. Here you have AI-linked stocks. They led the S&P 500. And as you can see there, no Mag 7 stocks. Interesting enough, not even NVIDIA, SanDisk, Western Digital. These are data storage companies. So related to the AI investment, obviously you need to store data somewhere for obviously individuals to access it through ChatGPT or Anthropic or Gemini or whatever platform you're using. So these names benefited from that. Micron is a memory chip company producer. We need memory chips as well. Seagate, another data storage. Robinhood, which is the online platform to trade pretty much everything these days, stocks or even getting involved in sports and sports betting. Warner Brothers, that's an interesting one you probably wouldn't expect to see. And the reason why they're there is because right now there is a big negotiation between Paramount and Netflix and Warner Brothers Discovery to acquire Warner Brothers. And the big fight is on in the US for that. And that has driven up, obviously, the price of Warner Brothers stock. Newmont Mining is your gold, and Palantir, another AI investment or AI company. As I said here, one of the things you'll notice, no Mag 7 stocks. So let's move to the Mag 7 stocks and let's find out how they did this past year. There you have it. Who led? Alphabet led, up 66%. NVIDIA, second, up 40%. And then you have a few names that were up slightly. Microsoft, Meta, formerly Facebook, Tesla. And then you have single-digit growth from Apple and Amazon. And coincidentally, I've heard a lot of individuals starting to talk about Amazon as an outperformer for 2026. So what tends to happen? Last year's laggards end up being this year's winners. It's that contrarian style of investing, and that I talk about all the time, and what I use as part of my approach to making recommendations for investors. Let's go to our next chart here. This is a chart for PE ratio. And this clearly shows that we left 2025 at a high point for PE. It's hard to see on this chart, but right now, forward PE is probably around 22 times. You can see there that the average, 10-year average is about 18 times. Long-term average, somewhere around 16 times, actually 19 times, 10-year average. And right now we're sitting at 22, almost 22 and a half. So are stocks expensive? Yes, they are expensive as a whole, but make no mistake about it. There are many bargains within the indices that I think can be looked at depending on the type of investor you are, the goals that you have for your money. So don't just think because I tell you that overall the market's a little bit on the pricey side that you should not be investing today. There are many, many names that I think are fairly cheap that I've been recommending to investors. Let's go to our next chart, and the title is quite interesting. It's called All That Glitters, and it talks about precious metals like silver, platinum, palladium, and gold have surged through this year, along with, coincidentally, European defense stocks or the European defense sector stocks, and that probably has something to do with the United States telling the Europeans that they need to ante up more money to protect themselves. Obviously, the Russia-Ukraine situation was a catalyst, I'm sure, for more defense spending. And who reaps the rewards of that? Well, it's the European defense stocks, as well as American, U.S. defense stocks. They did well as well. I know it's difficult to see the names along the side, but the top bar is silver, as I mentioned, more than doubled, 160% higher than platinum, then palladium. Then you have your U.S. defense stocks, and then gold coming in just under. I said originally over 70%. This chart says just under 70%. And an interesting year. Again, some of the topics near the top are not ones that you may have anticipated happening. Mag 7 tech names, Mag 7 up 22%, somewhere in the middle of that chart. So interesting to look back and see how 2025 performed, put some numbers on some things. We do it all the time here, Allan Small Financial Group, always looking back to see what we can do going forward. We know history is the biggest and best indicator of how market will perform going forward, but obviously there are no guarantees. And so I guess the main takeaway is it was a year for material stocks, it was a year for materials, and that led the TSX higher. If you compare the Americas to many other places around the world, it actually underperformed. And it was a resilient year for the market in the US. It rebounded from a low of almost 20% in the springtime to be higher by almost, well, just over 16% by the end of the year. So all in all, another great year for individual investors. Top 3 things for individual investors to consider before you make your investment decisions over the next couple of weeks. And as you recall, our last show, we actually had a top 5 list for 2026. We're now back to more, every 2 weeks, giving you a list of a few things that I think you need to be watching or be mindful of. So here is our list for today. Economic data out of Canada and the US. What economic data? We got a big jobs number report coming out this Friday. Jobs Friday, as we like to say, in Canada and the US. And we also have very important inflation data coming out next week in the US as well. So we're going to touch on that information. Markets still have a bit of a hangover from 2025. When we were putting together our first show of this year, we were kind of all coming to the same conclusion. The same topics that were important at the end of last year were pretty much the topics the market's focusing on this year. Bit of a hangover from last year. So we're going to talk a bit about that. What is the January effect? And what is the January barometer, and why is it important for investors? We tend to talk about the January effect every start of every year. And I think it's important because it's a positive indicator, and the market tends to follow more often than not the January barometer. So let's get into our first topic, economic data. And as I said, economic data out of Canada and the US, jobs Friday, December jobs coming out January the 9th. And then we have US CPI, or Consumer Price Index, coming out next week, June 13th. And Canadian CPI looks like won't be coming out till the following week on January the 19th. So why is it so important, this jobs number? Well, today we heard that the United States private payroll number came in a little bit disappointing. ADP came in a little disappointing in the US. So that meant that private companies, not publicly traded, but private sector payrolls were down more than the market was anticipating. How will that play out when we look to Friday? Well, we'll just have to see. Our first chart is one that goes through US jobs by month. And look at that scrambly, look at that up and down towards the end of last year. A lot of that had to do with the government being shut down. Information was not given. Information was not, as many believe, as accurate as we would like to see. And so we had jobs being down and then up and then down and then up. And it was all over the place. And I think this Friday could be, in my opinion, the first, I guess, more accurate number. Obviously, the U.S. government, it has been open now for quite some time, many days. And so we should get an accurate report out of December. And I've heard a few economists talking about how the first quarter of 2026 will give us a really good picture as to how jobs are doing and what the job creation looks like in the United States. Let's move over to Canadian employment data. And there you have it. Look at the growth in jobs, September, October, and November. Our government was not shut down, so we're relying on this data to be accurate. I was talking to some individuals recently, and they're actually questioning some of the data. They're saying that, yes, maybe the headline number looks pretty strong, but they're actually questioning just how strong it is. Some of the recent jobs growth last month came actually in, most of the jobs growth, if not all, came in the part-time area, which is not what you want to see. Also, in October, a lot of that growth came in the part-time area as well. The good part about it was we actually saw some pickup in jobs in the student-led area. Students looking for jobs, young adults looking for jobs. We actually saw a bit of a pickup there, which is great, but on the part-time side, not the full-time side. Remember, our unemployment rate went from 6.9% down to 6.5%, something that I don't recall seeing. I guess a pullback or a fall of 0.4% in just 1 month. Great to see, but I think a lot of people are questioning it. So let's see what the number looks like on Friday. If it's another great number, it will definitely go a long way to back up the numbers that we saw at the end of last year. Our next chart, U.S. Consumer Price Index, U.S. CPI, you can see it there, that less food and energy, which is core, which is what the Fed looks at, 2.7%. The headline number, 2.6. That has come down quite nicely since it was 3% just a few months ago. And again, some people are questioning the accuracy of the data in the U.S., obviously because of the government shutdown. Canada's annual inflation rate, our next chart, we can pull that up. It looks like there it is. It's come down nicely as well. The headline number, 2.2%, so just above the target, which is 2%, and the core number, 2.8%. That, to me, is coming down as well. It was 3% core for a little while there as well. So major data, or very important data, coming down the pipe over the next few days with jobs, and then next week, I say U.S. inflation, and the week after Canadian inflation. This is what the Bank of Canada and the Federal Reserve are going to be looking at. And just one aside here, I saw a press conference from Premier Doug Ford, and I think he hit the nail on the head. He talked about cutting taxes, putting more money in the hands of individuals living in this country. We know GDP or growth is stagnant, maybe 1% at best this coming year. That's the prediction. Perhaps some of the data coming out, jobs, inflation, maybe that'll give ammunition to the Bank of Canada to start cutting rates again, hopefully making things a little bit better for all of us living in Canada. And if the federal government would also back that up with a tax cut, I think this country could come roaring back with a lot more growth. So hopefully we see government help and assist with growing GDP and helping private businesses, helping public businesses, helping businesses want, or making businesses want to do business with us here in Canada. Our next topic or point, or second point, that individual investors need to focus on before they make their investment decisions. And that is, markets are still in a hangover. And why did I put this for today? Well, we're still in this tech hangover. Anything tech, anything AI, AI all day for all people. I think that was a quote by Lisa Su from AMD. She said that at the CES show, Consumer Electronics Show, this last couple of days. And really, the hangover continues. It's all about AI. It's all about tech. And yes, I think this is going to continue. This will not change. I know towards the end of last year, we were a bit of a holding pattern. There wasn't much of a catalyst for investors. I think there was a lack of a catalyst. We didn't see really a Santa Claus rally, kind of flatline the last part of 2025. But here we are in 2026. We have the Consumer Electronics Show, which we'll touch on a little later in our show here. We have taxes coming down in the United States. No tax on tips, no tax on overtime. The great big beautiful bill, as the president calls it, kicking in. We have a lot of AI, and things are becoming more efficient, and money being saved right across the board in many areas for businesses. So a lot of good things going on, and a lot of that will hopefully spur on growth and hopefully be a catalyst for 2025. I listed here in our first illustration, I guess, some potential market catalysts for 2025. And here you have them. Strong quarterly earnings. We're going to get earnings kick off our start in a couple of weeks. Usually JP Morgan kicks off the earnings season. The big banks in the United States kick off the earnings season. We'll see how they go. Hopefully it could be another positive and strong quarter, fourth quarter of last year. The new Fed chair assumes his role this year. That person promises to be more dovish, more in the area of cutting interest rates versus raising them or keeping them the same. I think President Trump is going to elect somebody who is willing to continue to cut rates and stimulate the economy. Fed policy rate changes that hopefully will come from the current Federal Reserve Board. If no changes are made or cuts made before the new Fed chairman comes in, I think the market is expecting a couple of cuts for the year. Let's not forget Supreme Court decision on Trump reciprocal tariffs. Supreme Court still has not ruled on whether the Trump tariffs are legitimate or legal and could be done. I've been hearing that we may hear something from the Supreme Court as early as Friday of this week, but I've heard some deadlines in the past and they've come and gone. So we'll see what the Supreme Court says. And last but not least, as a catalyst, major geopolitical event. Well, we saw one recently, right? The United States going into Venezuela, removing their leader from power. And is that a catalyst? Perhaps. Is that a catalyst for oil companies? Perhaps. Or perhaps it is a negative for oil companies. And we'll touch on that a little later in the show. So, we are in a bit of a hangover. I think individual investors need to understand that. And but the good news is we seem to be coming out a little bit. A lot of good news in tech land has helped the markets move higher. Our third and final point that individual investors need to understand before they make their investment decisions is the January effect and January barometer. What is the January effect? Simply put, it is, as we can put up the definition of January effect, there it is, the supposed tendency of stock prices to rise in the first month of the year. Why do they rise? Well, we don't know exactly why prices rise or the markets go higher. We know that the first 2 weeks of January sets the tone for the rest of the month, and the month of January sets the tone for the rest of the year, which we'll get to in a second, is called the January barometer. But we don't know exactly why January is a good month. Perhaps it's, all that tax loss selling that individual investors do in December. Well, maybe people start buying back in after 30 days in January. We also know that it's a new year, a new beginning for many people. Perhaps people look to make their RSP contributions, look to make contributions to their portfolio, to their tax-free savings account, and all the different types of accounts that exist today. So maybe it's just because, simply put, a lot of money starts looking for a home at the beginning of a new year. Smaller companies tend to do better than larger companies for obvious reasons, right? Not as many shares outstanding, not as much in the way of shares trading. And so small companies tend to do better than large companies. Let's move on to our next definition, and that is on the January barometer. And here it is. Some traders believe that the S&P 500 index January performance can predict its performance for the rest of the year. So, for example, proponents of this January barometer believe that if the S&P rises between Jan 1 and Jan 31st, this will foretell a positive result for the remainder of the year. Similarly, it holds that if the market fares poorly in January, it likely will perform poorly for the rest of the year. Key takeaways: the January barometer is a market hypothesis stating that returns in the January predict those for the rest of the year. It is popular among some traders, and it was first set out in the Stock Traders Almanac. The January barometer is predominantly a U.S. phenomenon associated with the S&P 500. So as goes January, goes the rest of the year. And I've actually seen or read about if January actually has a negative return, it doesn't necessarily mean that the rest of the year is negative, because we have seen comebacks for the market after a negative January. But if January is a positive, I think it's something like between 70 and 80% of the time, you're going to get a positive year. And I believe last year was a positive January, and then markets fell in the spring and then rallied pretty much the rest of the way. So let's keep an eye on things such as the January effect over the next few days. Let's keep an eye on the month of January as a good barometer for the rest of the year. We obviously know that the markets are continue to be in this tech hangover, if we want to call it a tech hangover. But the good news is, with a lot of tech announcements recently, markets are doing quite well. And economic data, that is probably going to be the first thing that we want to focus on before we make our investment decisions. Come this Friday, we're going to get some key economic data, some key jobs data out of the US and Canada, and it definitely promises to be a market mover. So we look back at 2025. Well, what do we think about 2026? I touched on it briefly, I guess, a few segments ago. I had said that my expectation would be that the market would do well, but perhaps just not as well as the returns that we've seen over the past few years. And for those that are watching, you're probably saying, well, that's kind of obvious. Well, I thought that last year, and look at the year that we ended up having. Double-digit growth, many investors making 15% plus returns on their growth oriented portfolios. So even though we were thinking it would be an average year, 8, 9, 10%, it ended up being well above average, even with the April pullback that we saw last year. So what are individual investors thinking this year? And there was a survey done, and we have the results. Let's pull up what strategists viewing the market performance for 2026 are saying. There you have it. By this time next year, S&P 500 will be higher by more than 20%. 11% of the people think that that will happen. Higher between 10 and 20%. That is the biggest number, 31%. Higher by higher by less than 10%, 29% of those surveyed. So when you add up those numbers, you get what? Over 70% of individuals believe that it is going to be a positive year. Whether it's less than 10, greater than 10, or greater than 20, but you're seeing that most people believe it will be another positive year, and I too am in that camp. On the left side of that pie chart, you're seeing here, lower by less than 10%, 12% of the people, and lower by more than 10%, a percentage of 16% of the people surveyed. So it sounds as though a lot of people are on the positive side of the boat. Now that, at times, being a contrarian, as you know that I am, tends to make me a little nervous. When a lot of people are on one side of the boat, you know what happens to the boat. It can sink. And hopefully that will not happen this year. I think last year, a lot of people were on the positive side of the boat, and look at the year that we had. So if you are a contrarian, try not to let this spook you too much. I look at it and rationalize it as, I think it's going to be a good year, but just not as good as last year. So that is what I think individual investors' expectations should be. Our next chart is an interesting one. One of my favorites for this show. Looking at the markets for 2026, can they repeat? You know, the S&P 500 has posted 3 straight years of gains over 10% a few times since 2000, or the year 2000, but a fourth such year in a row has been elusive. That's the title of the chart. You can see here, look at the blue. Back, I guess, at the end of the 90s, or beginning of 2000, I should say, we had 5 years in a row of positive numbers. A few of those were less than 10%, however, and then you had the big pullback in 2008. Then you had another bunch of years that were some above, some below 10% growth, and then a pullback. It seems to be hard to get 4 years in a row of 10% plus gains. And so I believe that. I agree with that. I agree with what this chart is demonstrating. And history is telling us that it is tough. It is, of course, tough. What happens when you have markets move higher, individual stocks and investments move higher for so long? Well, as we've talked about many times on the show, the bar just keeps rising. And as the bar rises and rises and rises, the opportunity for disappointment rises as well. So there's only so long a name like NVIDIA can grow 62% revenue growth, or keep their 75% margins, or represent such a large component of the S&P 500. Now, I don't mean to pick on NVIDIA. You could say that about many stocks. Look at some of the big winners that we showed you earlier, the Seagates, the Western Digitals. How long can they keep outperforming? You become a victim of your own success. And so for me, it makes sense that, yes, I think we're going to have a positive year. I just don't see it as positive as the years we've had in the past. But make no mistake, I think you'd be obviously better off investing. I don't think there's much in the way of alternatives. For those looking for growth, interest rates are just too low. TINA is applying once again. TINA standing for there is no alternative to the stock market if you are looking for growth. We always tend to focus on the positives of artificial intelligence. All the good things that it's going to do. It's going to make us more efficient. It's going to allow us to do things in a shorter amount of time and give us more time to do other things, perhaps some of the things that we'd like to do versus the things that we have to do. But there are some unintended consequences to AI, and wanted to bring them to your attention. And one of them, as we all know, that we talk about all the time, is the unintended consequence of AI taking away jobs. The early entry or the low entry level jobs, that starter job, student jobs, the jobs that people get, the harder workers come in, they do the jobs, those initial entry level jobs, and a lot of those jobs, unfortunately, have already been taken away by AI. So AI doing those jobs for people. It's allowed businesses to be more cost effective, more efficient, but it has made it's made things harder for people to find a job, especially students. This is what we've seen so far. But as AI becomes more and more complex, as the compute becomes larger and more powerful, who knows what jobs AI can take away. And a lot of the jobs that AI is replacing right now seems to be in the software space, whether it's software engineers or just software in general. So labor and the loss of labor, labor growth, jobs growth not being as strong could be a consequence and has been a consequence of AI. However, some, like Lisa Su, CEO of AMD, has said that's not necessarily the case, that it's just different jobs that are being created today versus the jobs of the past. So jobs, unintended consequence of AI. The next unintended consequence is one you don't think about all the time, and that one refers to energy. How much energy does it take to power a data center? And how many data centers are there out there in the United States, for example, today? How many are being built? There's a lot of them. There is a drain in energy, and some officials in certain states are starting to complain about it, that their people, they're seeing their electricity bills moving higher because the demand for electricity and power is so great. When power exceeds, when demand exceeds supply, prices go higher. Our first chart here, how much electricity will AI and data centers use? Well, there you have it. Look at this chart. 2023 is on the left side. Here we are in 26, the middle of the chart, and look where 2028 ends up being. AI-driven inflation is 2026 most overlooked risk, investors say, as of January the 5th. That's the caption at the bottom of this chart. So if energy prices go up, I would say many things go up, and that could spur on inflation. No wonder why the president is trying to bring down the cost of energy or oil on the other side of things by increasing production in places like Venezuela, increasing production in the United States as well. Our next chart on this topic is a great chart as well. Electricity use for commercial computing could surpass cooling, ventilation systems. Here you have it. Compute is going to be the most dominant energy consumer over the next, let's call it 25 years. And you can see here, space cooling, lighting, refrigeration, and then computing. Look at that curve. It literally goes from the bottom left to the top right. And so in general, AI is going to help a lot of businesses. Eventually, the big businesses will start out, but eventually it will even seep into small business, mom and pop shops. I think they're going to be using it. All of us will be using it more and more to do research, to create things, to have it do things in seconds versus something that would take all of us hours to do. So it's going to do a lot of positive things, but we cannot look or turn our back on some of the unintended consequences, that being energy prices, inflation. We need more and more power generation and jobs. What is it going to do for the jobs of yesterday? Is it going to create new jobs of the future? Should students today be looking at getting into certain, I guess, educational fields or fields at their universities or colleges that will prepare them for the jobs of the future, for the jobs that AI will bring? Well, that's a question that I think many of you are already asking. So let's keep in mind all the unintended consequences of AI, not just all the positives, but also perhaps some of the setbacks that the AI can bring. This year's limits for RSPs and TFSAs, want to touch on those very quickly. Not much really change, not much in the way of change there. Our chart that we have for this segment, we can put it up. You look here, 2026 limits for RRSP. You'll see on our chart, there it is. It's always 18% of your previous year's income. So your 2025 income, that is used to calculate what you can put into your RSP up to a maximum of $33,810. Now, of course, if you have unused room from previous years, so you didn't max out in previous years, you get to add that to your allotment for 2026 as well. So you could have a bigger number than that. It just depends on, if you've contributed all the way through and if you've maxed out all the way through. You can see here, it's a little bit higher than 2025 max of 32,490. TFSAs, the government is allowing us to add another 7,000 for those that have not contributed to TFSAs or have not contributed the maximum. You obviously have a lot more room than just 7,000. The cumulative limit is now up to 109,000. If you're somebody who pulled out money out of your TFSA last year, you can now put that money back into your TFSA this year, plus another $7,000 Canadian. If you're someone who's contributing US dollars to your TFSA, you'll obviously have to do a conversion between US to Canadian because all these numbers are in Canadian. So yes, numbers are going big, or I shouldn't say big, but becoming bigger. They are rising, and that is usually based on inflation. Usually the government will increase RSP limits by inflation, even TFSA limits, because of inflation going higher as well. So those are your limits. You have the first 60 days of 2026 to contribute for either 2025 income tax or your 2026 income tax. So let's get out there. And for those that have not contributed as yet, hopefully you can contribute in the first 60 days for RSPs for 2025, or hopefully you can contribute to your TFSA for this 2026 year. Quick hits, part of the show where I take a look at 3 things that have been in the news that have caught my attention. And I'm sure some of these have caught your attention as well. U.S. designs for Venezuelan oil industry put pressure on Canadian oil stocks. As we know, the United States went into Venezuela this past weekend, I think it was, removed their leader and is now somewhat running the country and looking to increase the production of oil. We know that Venezuela has the heavy crude, very similar to the oil we produce here in the oil sands out west. And so many people fear that with the increase in oil production out of Venezuela to the U.S., this will affect Canada. We'll go into that. We have a few great charts for that. 2026 Consumer Electronics Show underway in Las Vegas, as we've talked about already. Jensen Huang, CEO of NVIDIA, Lisa Su, CEO of AMD, talking about new chips, faster chips, more powerful chips, doing things 10 times, 4 times, 5 times faster than the chips that are in existence right now. And last, AMD's Lisa Su talking about jobs and replacing people. Someone recently asked her, are you replacing people? She said, no, we're actually growing jobs or increasing headcount. So we'll get into her, what she said, her quote, shortly. So let's move to the first one, Venezuela, oil production in Venezuela. Let's look at our first chart here. It's crude oil production in Venezuela, and you can see here by the chart, crude oil production began to decline sharply in 2014. The leader of Venezuela, Maduro, obviously controlling as best as he could the country, the people, oil production. He was more a seller of, unfortunately, of narcotics, drugs, and ammunition and guns than he should have been. Obviously, focusing on more oil production. We believe that Venezuela has the largest oil reserves of any country in the world. That it was amazing for me to hear. It's getting it out of the ground and getting the companies in there to pull it out of the ground, like the Chevrons or the Exxons or whoever else. That is the struggle. Will these businesses or companies want to go there and help production? Well, I've heard recently that they're already on the ground in Venezuela since the United States removed the Venezuelan leader. So we're seeing there a little bit of an uptick. We know that one of the major importers of Venezuelan oil are the Chinese. We'll see if the U.S. taking over, removing the leader of Venezuela will have any implications for U.S.-China relationship. Another chart we have for this segment is the destination breakdown of Canadian crude oil exports. And you can see there, is there any doubt that we send most of our oil to the United States? 96%. We send a little bit to Europe. We send a little bit to Asia, United Kingdom. But most of our oil goes to the United States. This is why when the U.S. said that they're going to increase oil production out of Venezuela into the U.S., I think last I checked, 30 to 50 million barrels a day going into, sorry, not a day, but produce 30 to 50 million barrels going into the United States, at least to start. Could that be I guess, replace a lot of the oil that we send to the United States? That is the question. And obviously the markets did not like that. And on the, I guess, Monday, the oil stocks in Canada really pulled back. Our last chart for this segment is Canadian crude oil exports to the United States. There you have it. Look how much it has increased. And as I said, the last chart clearly shows most of the oil that we export goes to the U.S. And if another country starts muscling in on our exports on our territory there, the United States, and if the U.S. starts to look to Venezuela versus Canada, what will that mean for our oil companies? What will that mean for our economy? And that's why you're hearing Prime Minister Carney really talk about expanding and sending oil to other countries around the world. And we're hearing more and more about, building the pipelines that we need to get oil to port, get it out of Alberta and all the other provinces that pull oil or mine for oil, pull it out of the ground. We're trying to get it to port so we can send it to other parts of the world. Extremely important. Our next quick hit, Consumer Electronics Show, underway in Las Vegas, and a lot of announcements coming out. This is a fantastic show. They actually have in the show their own area for robots, funny enough. They never had this before, but they have so many robots walking around at the show that they actually have to have an area cordoned off for robots themselves. We have a chart here on some of the announcements. NVIDIA's Jensen Huang launches Vera Rubin. Vera Rubin, I believe, was an astronaut. He named their latest chips after this person. NVIDIA's push into autonomous driving we've heard about recently. Boston Dynamics humanoid robot gets a boost from Google's Gemini. Uber gives the world the first look at its robotaxi, and AMD's Lisa Su shows off her higher performing chips as well. So CES is usually a great show to showcase the latest and greatest in technology, and it definitely usually has a positive effect on the markets. Our last quick hit that I saw in the news recently is a quote by Lisa Su, the CEO of AMD, talking about jobs. Because somebody said, since you create the chips for AI, what does hiring at your company look like? And what she said was, I would say that we're actually not hiring fewer people. That's what she told CNBC on Tuesday from the CES conference in Las Vegas. Frankly, we're growing very significantly as a company. So we actually are hiring lots of people, but we're hiring different people. We are hiring people who are AI forward. So as many people are saying, it's not that we're going to lose jobs. The jobs of tomorrow will just look a lot different. So we'll have to see if that is true. Many people are very concerned that AI is taking away jobs. We've heard this many times in the past in history, but it always ended up creating jobs. The new technology ended up creating jobs. So hopefully this will be the same this time as the world continues to focus on AI and its effects on the economy. what's my take? This is the part of the show where I take one question from our audience. Usually it's one question. Sometimes we can get two in. One here I think obviously is very timely. I received this one over the weekend. Now that the U.S. is in control of Venezuela's oil reserves, what is your advice to investors who own Canadian large cap oil producers as, I guess, stocks? Great question. Well, I have to say, first up, I have been market underweight oil. In fact, I have sold off many, or I've recommended to investors selling off many of their oil positions. The only oil positions I have left in or with my investors are ones that pay a good dividend and where that dividend is secure, because I believe the price of oil over the long term is going to continue to decline. And how can oil companies do well if the price of oil continues to decline? Now, yes, if a name like Chevron goes down to the US and they are involved in producing more oil, so yes, producing more at a lower price could still mean greater profitability. But for those that production is pretty stable, whether it's Canadian oil company or US oil company, and that is not growing, and now you have a lower price per barrel, whether it's WTI, Canadian Western Select, or Brent crude over in Europe, for example, if prices of oil are falling, it is difficult, in my opinion, to own oil stocks. And I believe it is the mission of the President of the United States to get oil prices down as much as possible. So with that, I want to say thank you to everybody who tuned in to our first show for 2026. As I said off the top of the show, we look forward to having many more great shows with great guests this upcoming year. We actually have a great guest coming up on our next show, which will be Wednesday, January the 21st at 12 noon across all social media channels. We will have an interview with David Patterson, Ontario's representative in Washington. Great time to have David on our show. We had him on this past year. We're going to have him on again. He's going to talk to us about the latest regarding tariffs and trade and CUSMA negotiations. So as always, it promises to be another great show. So until then, as I always like to say, happy investing.